So, hi everyone, this is Finance Meets Real Estate. So we meet here every Tuesday, 6:30 p.m. Eastern time. So we have amazing lecturers. We've had like some great lecturers over the past 18 months, 2 years or so. And so today I'm going to be presenting myself actually on based on the topic of undervalued investing in undervalued markets ahead of a recession. So it's an interesting topic. And I want to kind of get some of your feedback as well on that. Let me share my screen. Okay, just one moment. I'll make sure. Okay, cool. Okay, so does everyone see my screen okay? I just want to make sure it's fine. If you want to put on the chat, perhaps on the chat, if you see the screen. Okay, cool. Okay, great. Yeah, so investing in undervalued US MSA specifically, we're going to talk about today. Ahead of a recession that we don't know when it's going to happen. A little bit about myself. So I'm founder of RealtyQuant. RealtyQuant is a company that brings data-driven quantitative techniques to the real estate industry. So we have market analytics, property analytics, a few different products. Make sure to check them out at realtyquant.com. I'm a financial engineer by background, and I've been an investor in the past couple of years. So analytics speaker as well, and I host this series myself. And I have a financial engineering degree from Columbia, and I used to work in finance for about a decade. So that's about me. So I speak on different events. Part of it is the topic that we do today, actually. So I've done probably like 50 or 60 events on some of the topic that we are covering today, but it's a new study that I'm sharing today. So it's actually very interesting, very, very great findings. At least to myself and to my own work. And okay, so disclaimer, it doesn't constitute, formal investment advice. And so we're going to touch on like few topics. So market valuation, price performance, current valuation in different metropolitan areas, and some back studies. Okay. So just like a few questions, like before we start, I just want to check like with you guys, basically like I want to get like a poll of like what everyone thinks like on each of these 4 questions. So essentially, so say we have a mild recession, we have a severe recession. Like what is the number in your head? Just put it on the chat. What is the number in your head for a price decline in a mild recession versus a severe recession? What do you expect? So if you want to just put on the chat, like, is it 10%, 20%, 40%? It's presumably different in different markets. Okay, 15% versus 35, 25% price decline. Okay, that's interesting. Okay, 10, 20, cool. Okay, so, right, so in what duration are those declines? Like how long does it usually take? If we have a mild recession, if we have a severe recession, just off the top of your head, is it 1 year, 2 years, 5 years? How long does it take? Okay, 6 to 18 months, 1.5 to 2 years. Okay, cool. Okay, now, so where do you think like we all know where has been the high appreciation historically, just price history, so we can see that, right? So we all know like the highest appreciation has been in the West and it has been in the South. Now, what do you think about the next decade? Do you think it's gonna be in the West, the South, the Midwest, or the Northeast? Okay, Northeast, West, Northeast, West. Okay, interesting. Okay, cool. And what do you think are like some of the most, like some of overvalued and maybe undervalued cities or metro areas? And what percentage of metros are overvalued? If you want to name some, some names, be it Austin, New York, San Francisco, etc. What are some MSAs that you think are overvalued right now? Baltimore. Okay, let's stick to overvalued. So that's okay. Baltimore. Okay. Okay, that's our well. Okay, Texas metro areas overvalued. Okay, interesting. Okay, Los Angeles, New York City. Okay, okay, interesting. Okay, cool. So that's good. So some of these questions. So the first three questions we're gonna attempt to answer with essentially this table. So it's a table with a lot of numbers, but it actually serves to answer like most of these questions in a few different scenarios, or attempts to answer them, let's say. So the methodology, so here what we see in this table is a lot of numbers, not to be like intimidated, it's like too much or something like that. But essentially what we see is we see like buckets. So the leftmost column, we see buckets of overvaluation. So we're going to get into that later. Overvaluation, essentially just taking my word for it for now, essentially like deviation from fundamentals. Okay, you can think why that matters, you can think how it's predictive and so forth. We're going to touch on that later. But suppose we knew how percent overvalued different markets are. And so this is a study of like actually doing, bucketing different overvaluations ahead of what was a mild recession 1990 and the severe one, global financial crisis. And now in each of those buckets, it's saying, what is the price appreciation for 1 year through 10 years ahead? So that's probably arguably like the most important price appreciation table you will see ahead of a recession in real estate, in my opinion. So that tells you like essentially 1 year to 10 years ahead if we get a mild recession. That's a specific historical, it's a scenario. Specific historical mild recession, specific historical severe recession. What happens at different overvaluation buckets? Another thing it tells us, the second and third column, for instance, for the mild recession, tells us, okay, peak to bottom declines in those buckets, and it tells us decline durations. How long does it take? So essentially, if we come back to our questions, I don't know if I can do it. Okay. If we come back to our questions, so the first three questions, the first two questions get kind of addressed, or attempts to be addressed in this table. And then the highest appreciation, that's going to depend in which of those regions we have the different valuation buckets. And so, but this table is essentially giving us a distribution of appreciation across valuation buckets across time for multiple years ahead, 1 through 10. And it also gives us downside risk. It gives us declines, it gives us decline duration. So it's a pretty thorough picture of a post-recession market dynamic, let's say. So that's to me like for today, like the most important table we will see. Okay, so let's look at it like basically and try to understand what we are seeing here. So a few observations. So we want to look at price performance. We want to look at the declines. So in terms of price performance, so what we are seeing is it's like a perfect ordering across time and across valuation, essentially. That's what we're seeing in the table. So what we're seeing is like the most undervalued bucket, and again, undervaluation being deviation from fundamentals. It's a measure. How it matters, we're going to look into that. Now, but again, so if we look at the most undervalued bucket, minus 10%, 10-year ahead performance, 54%. In a mild recession, we look at the most overvalued one in that case, 50 to 60%, 16% appreciation in a mild recession. And then in a severe recession, well, it has like different performances. It's still under the peak. 10 years later, the most overvalued bucket, it's like 25% under the peak. And the most undervalued one is 25% above the peak. And so do you guys have any questions, like just like looking at the table, like, is it high level clear? Like just yes or no, like on the chat, like, is it high level clear what we're trying to show here? Just yes, no, it's okay. Okay, not really. Okay, cool. Not really. Okay, interesting. Interesting. Okay, cool. So what we're trying to think of the first column. So suppose you want to buy a market and you want to buy it at evaluation. The way you buy a property, so you buy a property, you pay a price. You can pay the market price, you can get a discount, you can get a premium. If you buy a market, now you're buying real estate, you're not buying technology stocks or something. You can estimate statistically, it's a statistical estimate. It's not as precise as getting a property discounted, but you can statistically estimate if you're getting a discount, if you're paying a premium. So that discount, if you get a discount of 10%, so that's your undervalued bucket. If you get pay a premium of 20%, that's your overvalued. So all that it's saying is, suppose we have a market, let's say Phoenix, Phoenix, for example, and let's say Phoenix is 40% overvalued. Let's say, just an example, it's not the exact number. And so Phoenix is going to be in this bucket, 40 to 50 in this case. I think Phoenix is, well, it's roughly, Phoenix is around 50 in reality. And we're going to get to that. And so it's like 50 to 60% overall. So the question here is, if you buy a market that's overvalued, what's going to happen 10 years ahead? And if we are near the peak or at the peak, and what this table is precisely at the peak, but we're going to get to like near the peak as well later. And so the question is there value to buying undervalued? Is there value to buying overvalued, or sort of a harm to buying overvalued? Because we've seen some of the markets that we could expect to be overvalued, like we've mentioned, we heard, for instance, like it's a guess, like let's say Texas metros perhaps being overvalued. Now we know they're doing incredibly well in appreciation terms. So the question is, how is that going to play out in the future if we get a mild recession? How is it going to play out if we get a severe recession? So does that help to clarify a little bit? So for instance, if you buy a 20% overvalued market, so discount 20 to 30%, we get a mild recession. It's going to experience, it experienced in 1990 mild recession, it experienced a 10% peak to bottom decline. The decline duration was 4.2 years. And then for 10 years forward, those were the price changes that happened. First there were some declines, okay, then it picked up, it appreciated. So 10 years later, it was 27% higher. So that's what the table is showing. So is that, I want to make sure, is that understood, this part? More or less kind of yes, no, is it a little bit clearer perhaps? I don't know. If not, I would try to explain it. Okay, still same, yeah? So, okay, fine. So let's look at, let's look at simply declines. Let's forget about appreciation. Maybe it gets too many numbers. Let's look at global financial crisis. So global financial crisis, there were peak to bottom declines. If we had a market that was metro area that was greater than 80% overvalued, some of the ones in California at the time were like that, it declined 52%. That's what the table is showing. If we had an area that was less than 10% undervalued, it declined only 4%. Yes, exactly. Yes. So Isidore is saying, so meaning if you bought it 20% overvalued, it declines 10%. And then, well, it declines 10%, yes. And sorry, the 20% you're saying, the 20% declines 10%, and then it increases whichever percentage each year, respectively. That's true. Yeah. So it takes few years to decline, though. So exactly, yeah. So that is correct. Yeah. So all that it's saying is we buy at the peak. We buy at the peak. So this is market valuation at the peak before a mild recession or a severe recession. And those are just two historical ones that happened in the past 45 years. We buy at the peak. We get at the peak, we can have a different valuation. Some market can be undervalued at the peak still. And so if we bought, again, if we bought the most overvalued market ahead of a severe recession, like the global financial crisis, declined 52%. But if we bought the most undervalued set of markets or metropolitan areas, they declined 4% only. And generally, undervalued metros, states, counties even experienced extremely small declines. Even global financial crisis, they generally never almost decline. The average decline actually that was for these metros, they're around 400 metros. For the whole set of undervalued was close to 6%, which is extremely mild for something like global financial crisis. On the contrary, the overvalued buckets, they decline like 40, 50%. So that shouldn't be as a surprise. So that kind of, okay, makes sense. But actually having something, its valuation aligns so well, or overvaluation aligns so well with percentage declines is the first observation here. So we see almost perfect ordering of how overvalued a bucket, what overvaluation and metropolitan area has and how much it declines. Now, the interesting thing is, what if we get a mild recession? So most people think we get a mild recession, we get, let's say, a 10% decline, and who cares? And then that metro area picks up. It just picks up, continues, it does incredible after. So here is what happened after this specific mild recession. So we had something that was overvalued 50 to 60%. At times, those were markets in California and Hawaii. So they were overvalued 50, 60%. They declined only 14%. So something being overvalued 50% does not mean it's going to decline too much. Why? Because, not because in another scenario it crashes and the other scenario is a crash and this one is not a crash. It's because the economic recovery is strong. So if you look up, like you can Google, there's Pew Research, I think, or something, Pew Research Center. So they have like some classification for recessions and they discuss exactly 1990 versus global financial crisis. And they discuss 1990 being a mild recession with a strong economic recovery and global financial crisis being one of the most severe recessions in the past couple of centuries even as far. And so we have like a very mild and very severe recession scenarios in those two cases. And so, and so the decline that is in a mild recession ends up 14% for something that's 50% overall. That's quite interesting. Why? Economic recovery is strong. Fundamentals pick up well. So personal income picks up well after the recession. And since decline durations, as we see in this table, are generally pretty long. So it takes 4 or 5 years. In both of those cases, it took like 4 or 5 years, at least for overvalued buckets to actually reach to the bottom. It's a very long time. Now, if in this very long time, we have a strong recovery, in the same 4 or 5 years, fundamentals will pick up. So we're going to get personal incomes being at higher levels and so forth. And prices will be slowly trickling down. And the two are going to meet at some point. And by the time we're like 5 years later, these same 50, 60% overvalued metropolitan areas are going to be right at 0%. Now, in reality, they even go slightly negative. That's kind of what history suggests. But, suppose they kind of roughly go to 0%. And so all the overvaluations are solved, but it really is resolved on the fundamental side, largely in a very mild scenario. Now, that's not what happened during global financial crisis. During the global financial crisis, being, again, quoting like Pew Research Center, like one of the most severe recessions in the past, I believe, 2 centuries. And so it's actually what happened is incomes declined. So 4 or 5 years later, there isn't too much economic recovery. And so over these same 4 or 5 years, the full overvaluation essentially gets erased through actual declines and not through economic recovery. And so that's why the global financial crisis is so much more severe. It's just because the recession or the declines are severe, just because the recession is severe, not because crashes happen per se, because it still took 5 years for those quote unquote crashes to happen. And so this is kind of like the fundamental analysis of that. And so the interesting thing now in our real life scenarios, if we now buy a market that's overvalued, let's say 50%, what's going to happen to it? Is it going to be like, oh, it's going to drop in a mild recession? Most people now expect a mild recession, let's say. So is it going to drop 10% and then it just picks up? That's not what the data suggests. So what the data suggests is something like what we see in the table to the left. So it's actually, if it does decline 10%, but it's overvalued 50%, it's going to be a long time for that decline. It's going to be super stagnant. It's kind of what we see in the top bucket here. In Hawaii at that time, at 1990, it literally took over 8 years for prices to reach to a bottom that was 14% below. So that's not a big bottom, that's not a crash, but between 1990 and 1998, 8 years later, prices are, 14% below. That's not great. That's not a good investment. So that's kind of like the value of like buying in an overvalued bucket compared to another one. And now let's look at decline. We touched on decline durations in that sense. So decline duration depends on how severe the recovery, how good the recovery is, or severe the recession is. And also it depends on overvaluation. Now, if we have a severe recession, decline durations in that case were fairly more kind of evenly distributed. They're kind of close to each other, except for the very undervalued and still fairly valued buckets when they were like 2-3 years in the undervalued one. So it took 2-3 years, and it took 5-6 years in the overvalued one. So there was a difference, but still significant time, even 2-3 years, even in the undervalued buckets in a severe recession. Now, in a mild recession, what happened is extremely different duration. If you bought something undervalued in a mild recession, it practically didn't decline. It was literally 0% or very close to zero. It took like a couple of months, like slight downtick, you know, and then just prices just keep chugging along and continuing to rise. Now, if you bought something overvalued ahead of that mild recession, well, you're dragging yourself down for like 7 years ahead. And so like something like this. And so decline durations were very different in a mild recession, 0.2 years in the most undervalued bucket and 6.5 years in the most overvalued one. And so it's a function of where do we buy the market? Think of value investing, like think of the stock market or somebody like Warren Buffett. It's a function of do we buy it at a high, at a premium? Do we buy it at a discount? And the question here is where are we going to see the highest appreciation? And so what this is showing here is we consistently see the highest appreciation following peak for up to 10 years ahead at every year. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Every year we see it consistently for more and more undervalued buckets. So the more undervalued metropolitan area is, the higher appreciation 10 years after the peak it experiences. Now there can be different reasons to that. Now one big reason is declines take a really long time. So as we see here, for overvalued, they take like 5 years. So that really drags the process. After these 10 years, some of those very overvalued ones, they recover. But I think what some investors don't appreciate is actually how long it takes. So it takes a very long time. And so those are like some observations from this table. So let's kind of move along a little quicker. So if we take a look, so again, like some of the observations that I had were, okay, so more undervalued MSAs outperform consistently. So that's what we see in the table. If we look at the table above, the more undervalued MSA outperforms consistently, and it does on every time horizon, 1 through 10 years, every time horizon. And that happens after a mild recession. So think of the situation from mild recession. 1990, nobody even talks about. This is a non-event. This is a non-event for real estate. Do you know what's the decline for the broad US real estate index? 0%. 0%. But if you bought in 1990 in the overvalued buckets, you're dragging yourself for 7, 8 years ahead with slightly lower prices, 14% or something. And so that's kind of like the implication. And so basically how much a decline is a secondary question. It's not so important. It's the important question is what's going to be your price relative performance. And that's kind of what this table is trying to kind of show, that even if you get a tiny decline, it doesn't matter because you underperformed, over the long run. And again, it depends. Then you could have other implications because maybe you're investing on shorter term horizon and so on and so forth. And there are many benefits to buying like very overvalued markets before the peak. And like, I'm going to talk to that actually. And so, okay, so that's like, those are like some scenarios. On the 10-year horizon, the most undervalued MSAs, less than 20% appreciate 52% and so forth. And we looked at these numbers. And so generally they had experienced the strongest price appreciation over a 10-year ahead time horizon. Okay, decline duration, we looked at that, almost perfectly ordered declines with ranges of overvaluation. That's the first observation that I have discussed on many lectures. This should come as no surprise. If you have more overvalued markets, they decline more after a recession. That's just what happens if you do fundamental analysis. Fundamental analysis in real estate works. It doesn't work in the stock market well because we have the technology sector. I'm not able to do it. I'm a financial engineer. I'm not able to do it in the stock market personally, but in real estate, it does work. And yeah, and it's actually done by Moody's Analytics and a few like bigger firms, but somehow not the small investors. And okay, and so now, 1 second. So let's look at, decline duration. So as we discussed, they depend on how strong the recovery is. So strong economic recovery with growing real estate fundamentals, with richer income, and then there's dependencies on population, housing supply, how housing shortage evolves essentially. So that leaves us with a very residual price decline only, and so we get a small price decline. If we have a very weak recovery, then we get big decline. So that's kind of what seems to be suggested in the data. But again, the other thing is like under and fair value, besides the smaller declines, they also get shorter decline durations. So the market recovers pretty quickly and then continues keeping along, while a very overvalued one can take a very long time to recover, even if we have a mild recession and very small declines. So those are like some of the observations. So whether it's like market valuation in different metropolitan areas. We publish it at realtyquant.com. but these are like some of the top ones. So it's been changing super rapidly. Like updated every quarter. It's very, very different. So where it was at the end of 2022 was that if you take the whole US was at 0%, was fairly valued. That was well reported by Bloomberg Economics that tracks different countries. They had US at fairly valued 0%. And on the contrary to, for instance, the scans economies, Scandinavia, for instance, Sweden, Canada, Australia, Norway, and New Zealand, which have very overvalued real estate until now. And they've been seeing like some declines perhaps already. But at Q4 2020, these were some very overvalued cities, kind of a little bit they were overvalued, and notably it was Boise. And I started like doing like some of this analysis actually in 2020 when I started getting involved with real estate myself. And so I was speaking about Boise at the time being overvalued, and that was actually basically the main exception. So that's like, was like, oh, that's like the overvalued city. There's not much else, you know. It was very fairly valued. Then through the third quarter of 2021, this started changing a lot. So it's basically like, so Boise, as you see, from 45 went to like 74. And now at the second quarter of 2022, it's at like 84%. And so these percentages have been increasing and increasing. And perhaps that could stop now, because maybe we start seeing a little bit small declines here and there, which is interesting actually. As to what exactly is happening, I'm not sure, but right. And so this is like some of the more overvalued cities. So metropolitan areas, that is. So they're in the states of Idaho, Texas, Arizona, Washington, Florida, Utah, specifically the top 10, that is, but you know, there are other ones. And so Boise is at the top. Boise is at the top also in Moody's Analytics study. There's a study by at Florida Atlantic University and a few others. So Boise is the most overvalued city in America, whichever methodology you choose, whichever thing you want to do, it's still Boise. And so, okay, but then we have Austin, we have a few other cities in Idaho, we have Phoenix, Arizona at around 50% overvalued. And that's in FHFA data, Federal Housing Finance Agency. And, you know, Cape Coral, Fort Myers in Florida, Tampa, Florida as well. So those are like some of the more. Now, again, the percentage may sound scary, but they're not so scary per se in terms of declines. Where they are scary is the underperformance you may see there, which is the table that I was discussing. But where they're not so much scary is if we have a mild recession, then the most overvalued, such as 1990. In a 1990-like scenario, the most overvalued city at 84% overvalued of Boise declines only 19%. If we just sort of do a regression of similar kind of, a similar scenario like 1990 recession. But in a severe recession, now that's like terrible. There. If you have something that's that much overvalued and something like the global financial crisis happened, then it's pretty bad. Then it's like 50% for Boise decline and so forth. But again, most people don't expect a severe recession. So hopefully it's going to be the mild scenario. So they're not very big declines, even though it appears it's so overvalued. But that again depends. One is not able to predict either scenario, in my opinion, because that comes down to predicting fundamentals. That just comes down to sort of predicting economic growth. So you can look to like some economists, how well they predict economic growth. And that's kind of going to be your gauge for which scenario you get starting at a given valuation. Okay, then the most undervalued ones, they're not very exciting. Okay, they're the states of New York, Pennsylvania, Louisiana, Maryland, Illinois, North Dakota. So they're like places like Johnstown, Pennsylvania, Binghamton in New York, and so forth. Grand Forks, North Dakota, you know, so like places that have been kind of out of favor now. What declines they would have in a mild recession? Almost none. So like kind of like 1-2%. Even in a severe recession, 4 or 5%. That's what happened actually during the global financial crisis, that all the undervalued MSAs, they had an average decline of 6% at the time. And the states had an average decline of 4%. So undervalued things don't decline, even if we get the global financial crisis. They very little decline. On a kind of, let's say, from the perspective of smoothened data that is quarterly governmental data that kind of keeps, I would say, like, that kind of has relatively lower volatility than maybe your exact property or neighborhood. It could be slightly different. And fairly valued ones, okay, in like the states of California, New Jersey, Pennsylvania, West Virginia, New Mexico, Illinois. Those were undervalued before in 2020, 2021, and they have relatively low predicted declines too. in the severe recession too. And again, this, if you're thinking these predicted declines are like a complicated model that I am building, it's not. It's the easiest fundamental analysis that you can do yourself. And it's also based off like what actually happened, like the actual declines that we saw. So like my confidence in something like investing in an undervalued market is stemming from that I've actually never seen a decline that's material there, that's particularly big. It for the reason of valuation. It could happen for other reasons, perhaps like population, abundance that area or something like that, but not like for the reason of valuation. And so okay, so those are like some of the current ones. So that's kind of just to see. Okay, so in terms of like the statistics of that, so like a total of like 25 metropolitan areas are more than 40% overvalued now. So like if you look at like some of these top 10, so we have like 25 that are above 40% in the Q2 2022 column. And then how many are overvalued? 60%. That is a very interesting thing. So at Q2 2022, so what I was mentioning at the end of 2020, beginning of 2021 was a fairly valued market. By Q2 2022, with inflation, with all investors saying buy hard assets because it's good for you, essentially, because you gain from inflation on hard assets. It drove the market overvalued. And so by Q2 2022, I'm not very happy to share that actually in this study, the numbers are close to the 2006 ones. So I have the whole history for 47 years. The peak, for instance, at the state level is at 20% in 2006. The same one, and that I still haven't put it for the states for Q2, but it's coming as an estimate of 17%. So these numbers are getting very close to GFC, still close to 2006, so to say. Still 2006 is more overvalued, but there's a different distribution now, and that's kind of interesting. And so coming to this, we have 60% of all metro areas are overvalued, let's say 10% and above. That percentage actually, 2006 was 47%. So we have a bigger percentage of overvalued ones now. Undervalued MSAs are now 12%. That percentage was 31% in 2006. So we had actually a lot of undervalued areas in 2006, but the fewer overvalued ones, they were more overvalued then. They had bigger percentage overvaluation and so forth. And then they experienced also very severe recession, which now we may experience a mild recession. So again, it doesn't mean it's not predicting declines, it's predicting relative kind of what price you buy at and relative appreciation. Now, another thing just to say kind of on the positive note for buying something that's overvalued, 1 year ahead performance ahead of a recession is what this table is showing. And so this is if you bought 2 years before 1990 or 1 year before 1990, or if you bought 2 years before global financial crisis or 1 year before global financial crisis, what would have been where would have been the 1 year ahead appreciation? Where does it happen across valuation buckets? Now, in 1990, a lot of the overvaluation happens way ahead. So it didn't happen actually in the last 2 years. There was no like excessive price growth happening in the last couple of years before, let's say, the recession was declared. And but at the global financial crisis, there was. And so the distribution was like very clearly, the more overvalued a market is, it's very good to buy it in the short run. And so you get like higher and higher appreciation in those markets. That's some of the dynamic we've been seeing now. So we're now seeing the dynamic of the two rightmost columns and not the two other columns for 1990, where we've been seeing, for example, Idaho being overvalued since 2020, having still the highest appreciation afterwards for the following 2 years. And so that's like, it's extremely valuable to follow the trend and the momentum actually. And that can be also tested like autocorrelation studies in real estate, by the way. It's extremely valuable. And so like buying the overvalued markets ahead of some peaks, not all of them, like 1990, no, it could bring like extremely high outperformance in the short run. And so that's what we've been seeing now actually. So we've been seeing the most overvalued markets severely outperforming the other ones. So if you wanted just to buy, like even not looking at the prices, and let's say if you had this study and you want to buy the most overvalued one, it's going to do the best too. And so that's interesting. So 1 year ahead performance ahead of a recession is stronger in overvalued markets. Now, but what happens for 10-year ahead performance? So let's say you buy, because we don't know when a recession happens. We don't have an official one now. Suppose you buy 1, 2, 3, 4, 5 years ahead of a recession, at whichever valuation you had 1 year ahead of a recession, 2 years or 5 years ahead of a recession. There's a degree of valuation or overvaluation at that time, and you buy at that point. Now, what's going to happen 10 years ahead? So this study is showing, this is an average of your 10-year ahead performance if you bought 5 years ahead of peak, 4 years, 3 to 1 years ahead of peak, the average of those 5 years. And what this is essentially showing is, no matter when you bought ahead of the peak, if you look at it on a very long-term, decade ahead performance, you underperform buying the overvalued buckets. And so that's what this is showing. This is showing starting up to 5 years ahead of even a mild recession. If you're buying the more overvalued buckets, starting up to 5 years ahead, on a 10-year ahead, even though in the short run, as we saw, the 1 year ahead is going to be stronger for you. Well, in the mild, it wasn't, but in the global financial crisis in the current scenario, which we don't have a recession yet, but just price performances up to now have been very strong in the overvalued ones on a 1 year ahead. But 10 years ahead, it underperforms. And so what this is saying is, for example, now we don't have a recession declared. And say it happens 2 years from now, or even 4 years from now or something. According to, if we get a situation like those two recessions, you will still underperform on a 10-year ahead basis. And so undervalued ones outperform if you bought them for the very long run, even if you bought them up to 5 years before the peak. So that's extremely interesting. And another thing is, now if we take, let's say we take the prices peak at some point. So let's say global financial crisis, they peak maybe 2006 and 1990, whichever they peaked, 1990, let's say, right? And so when did valuations peak? So overvaluations. So they peaked for overvalued markets. They peaked generally like 3 quarters earlier. So overvaluations now, I haven't seen them reducing yet. Now, perhaps we're going to see them reducing maybe in Q3, but I'm not sure if it's going to be the case in some markets. If indeed, like some of the price data of some metro areas declining a bit is there, then we may see overvaluations pulling back a bit in Q3. And then according to this, we have like 3 quarters, basically. So something like, so like 3 quarters, and only then price is actually to be, well, but that's if that's for the price decline in this case, the reason, then it's actually, then it was 0 in this recession. But in the previous ones, it's different. So it's kind of would be strange for me to see price declines already, because it took 3 quarters just leading indicator for first valuations to kind of, it makes sense first normalize prices to decline and then to see the actual prices to decline. But it's uncertain. Now, so one thing that, again, the table implies, and this is like a very thing that, is going to sound different probably from what others are saying, is that, so if we have the table that we saw at the beginning, again, let's come back to it like for a second. We have the table here that is suggesting that buying at the peak, and as we saw even a couple of years before the peak, or technically maybe even up to 5 years before the peak, but let's think of it 1, 2 years before the peak. If you bought the most undervalued markets, they outperform the other ones. So if that is the case, the current overvalued markets, they're in the West and in the South. So they're the ones that are in the 20 to 50% range, and some of them over 50% range. They're in the West and in the South. Majority are in the West, and then there's Texas and Florida mainly in the South, and to an extent Tennessee, and like a little bit others. But it's the whole West except California, and then parts of the South, but only parts of the South. And Texas and Florida, they're big parts now, naturally, and so the South is there too. And so if the West and the South is here at the 20 to 50% or 20 to 60%, and the Northeast and the Midwest is at the minus 10 to 20%, let's say, what this is saying is that for 10 years ahead, Northeast and Midwest would outperform. And so this is like the implication of a study like this, is that So that's a regime change. So that's not what people expect now. Because people expect now if we get a mild recession, we're going to get a 10% decline in Phoenix. Then it's just going to keep exploding after this again, because that's going to be fast. Now, Phoenix can keep exploding indeed, because it does have strong fundamentals. But what this is suggesting is it's probably going to take 10 years forward for that to happen. And so what essentially this is saying is that markets in the West and South regions like Boise, Phoenix, and Tampa are likely to underperform on a 10-year ahead horizon if we get any recession declared, even if it's a mild one. And so so that's like kind of the value of like this study. Now, this is based on like some recession back studies, and I'm going to go pretty quickly and like go on to questions. And like, so this is based on back studies of the two recessions in question, 1990 global financial crisis. The correlation of overvaluation, so that percentage that we're discussing, that essentially you kind of need to trust, right, for the whole thing to be valuable, right? The correlation for MSAs was 88%. So 88% of how, let's say the percentage overvaluation, if it's 40, 50%, or if it's minus 10%, and how much then the decline is, 88% correlation of actually predicting the future kind of thing. That's very strong. That's not random. That's just because it's real estate is fundamental. Like if it's not, then it's like somebody has to say like, why is it not? You know, it's like, I don't know why not. It doesn't make sense to me not to be. Like, what's the reason not to be fundamental? Let's say, what's the reason not to be driven by income, population, or housing supply? I don't know. It's like the burden is on, I think that person's kind of try to justify, because to me, like fundamental analysis inherently ought to work in something like real estate. And I can understand why it doesn't work in the stock market. That. And so, okay, so 88%, that back study for global financial crisis, 88% correlation. It's very interesting for confirming the methodology. And that's what I was doing at the time. I went to see, let's see almost a non-event. Let's look at 1990. It's a non-event, 0% decline in US prices at the national level, which US at the national level was undervalued. So not only 0%, so not undervalued at the time, the way we see it impacts over 70% of the metropolitan areas were undervalued. So how are you going to get a high correlation for something for declines where it's like 70% of your set is undervalued and they're going to get almost no declines? And even with that, the distribution had a 60% correlation. 60% is not high, but it's not terrible. Like the correlation of population versus price appreciation at the state level is 40. Like to people, like to syndicators who invest in high population growth areas, it's 40%. That's about it. So market valuation or fundamental analysis in real estate is fundamental as population or housing supply and things like that. Or deviation from population and housing supply is just equally fundamental. It has similar and higher, it's a single variable, but it's based on multiple, I guess. But it's a single already derived variable, has a higher correlation than any of those, than income or population as a single variable, which are at only 40%. And so it's quite interesting. And so that set that basically was undervalued. So imagine that bucket of 70% MSAs, they decline almost nothing. And then you have the other ones and they decline something. And then you get 60% correlation for that, which is still pretty high for a non-event. And so that's like quite interesting. And so, you know, the strong economic recovery after 1990 kind of goes in a way that. And so global financial crisis, just like going through like, if some of you know, like, or remember, like there were 4 states that were like super overvalued then. They were Nevada, California, Florida, and Arizona. And so in the first 3 of these are the top 10 MSAs at this time. And they're more overvalued than the current Boise, let's say. Now Boise is at 84. Probably would have ranked like number 11 or something ahead of the global financial crisis. So those are going up to like 156%. There were some fairly valued in like a ton of different states, North Carolina, Georgia, etc. And undervalued ones, for instance, Texas was undervalued, the whole state at the time. Midland in Texas was very undervalued. And the decline, I forgot to mention, actually, it's important. So in overvalued, the declines, as we saw before, it's like you imagine you invest in those top 10, you have like 56 to 60% decline, let's say roughly. And then imagine you invested in Texas at the time, which is booming. And again, something that's undervalued, it doesn't mean afterwards, it could be the most, this is an example of like some of the reversal even we're seeing in well, this is hypothetical kind of, but we are seeing in that earlier table where, okay, Texas, the very undervalued and also not so well performing place actually ahead of 2006. It was not incredible price appreciation. Then became the top, one of the top performers, for instance, and so forth. But that is a, that I don't want to get to that because that's only 10 years ahead is what we're looking at here. Afterwards, it's a different prediction. You need to be forecasting the fundamentals themselves and so forth. But anyways, and so, yeah, so these like Oklahoma, Texas, Iowa, Kentucky, Kansas, etc., they were undervalued. And the declines, they were just, take a look at this, 1 to 4%. 1 to 4%. Do you know how many MSAs were undervalued then? 123 MSAs out of 395. So 123 out of 395. If I share them with you in this framework, the average, you're going to be seeing numbers like this. Here and there, something higher, like 10%, you know, and the average is 6%. So that's like a third of your set of metro areas. And that's, recession is labeled like a real estate crash of sorts. I don't think it is. I think it is a function of how overvalued something is and having a terrible recession with very weak recovery. And so all the undervalued ones, there's no crash at all. So it kind of seems to a little bit disprove or change like the analysis of that, in my opinion. And so, okay, sorry. Yeah, and then just one. And then, okay, 1990, again, like 70 MSAs were undervalued, but there were some overvalued ones, and they were in California, Hawaii, Massachusetts, New York. California and Hawaii were like the main ones, very main ones at this time. There was also Oregon and a couple of other states that were overvalued and some fairly valued, and undervalued was like almost everything, or like, I mean, over 70% like we discussed. And so that's like in different states here, the bottom ones, Texas, Louisiana, Oklahoma, Wyoming. Decline duration, so we already discussed that. It's actually, even if you get a mild or you get a severe recession, a mild recession doesn't save you from long decline durations in overvalued markets. So there are still 4 to 6 years, roughly. 4 to 6 years, even if it is a mild recession. And then the comparatively mild peak to bottom declines for overvalued following 1990 still had the 4 to 6, basically. So that's it. So I have like some articles on this on my website. So kind of like what this presentation is the top article, like investing in over and undervalued metro areas. Which are the over undervalued ones is the second one. And like some of like the back study kind of discussion is the third one. So our data is published at realtyquant.com analytics. So I've released like a property, commercial multifamily property analytics product as well recently. If you want to invest with us, that's the link. And I'll be starting a data-driven real estate investing course, and also have a YouTube channel. So that's the information. So if you guys have any questions, let's try to go over them again, because I know it's kind of a little bit sometimes a lot, and some of the information comes out, maybe it's a little controversial, or not what people want to hear maybe. And so I'm curious what you guys think.
Hey, Stefan, I have a question. Great presentation, by the way, all insightful stuff here. So I guess it's really two questions, but they go hand in hand, so I'll ask them together. The first one is, I thought we were already in a recession. And the second question is that regardless of whether or not we're in a recession by definition, what I have seen in my market, and from what I understand is also happening in other major markets, is that there has already been extreme price declines since earlier this year. I know that firsthand with properties that I've actually bought myself. From just over the past 6 to 8 months, we've seen prices decline by 10 to 15% across town. And that's like real recorded sales of homes that sold 6 months ago and are reselling now. So how does that story fit into this whole narrative here? Does that mean that we're already halfway through a price decline potentially, since we've already seen such severe price declines from the peak?
I don't think so. I know what you're saying. So that's like some of the risk of like what you're saying is that, so think of like, so this study here, so if you look at like the source, like Federal Housing Finance Agency, so this is the smoothest thing. So here, like whichever declines I'm showing are like the smallest declines probably one would see in a way. Because like I did the same study, I'm not in metro areas, maybe I did also in metro areas. I did like the same study for states and counties. Okay, not counties, okay, for states, for states and some metro areas. I did it at for zero as well as case share data. And so one thing I want to say is it's very consistent. It's pretty, in terms of cross geographies, it doesn't change the story materially at all. But it does change a little bit. Zero and case share, they show they have bigger declines. And that's just what price history says. They have more volatility. So this is the government telling us what the real estate prices are. Even it's the most smoothened thing. It's like kind of like the best scenario almost, or not the best scenario, but the most smoothened scenario. And so what you're saying is interesting because yeah, in real life, so this is in data from the perspective of quarterly, kind of over the long run, quarterly, very smoothened data. And then what you're saying is, okay, how does it look in real life? Where now I bid on a property and the actual transactions you're seeing at 10, 15% below and things like that. And so, well, one answer is, I mean, this is metropolitan areas on a quarterly data. Are you going to see such 10, 15% declines? No, but indeed on your property, you can see bigger ones. And so that's actually a little bit the tricky side where I sort of feel, I sort of know that metropolitan areas in this quarterly smoothened data that are undervalued are not going to decline. But what I'm not 100%, I'm not fully sure, even like for my own properties that are in kind of like fairly valued markets right now, is essentially, are they gonna, in that what you're saying, in real life, just that specific property declines, or the volatility between within 3 months, let's say, is way higher than that quarterly one, or is just way higher in zero or real life that we see compared to the governmental price index and so forth. And so there is a data source question here indeed, and real life can differ for sure. And it's a very good question. But then the other thing is, if you're seeing declines, how does it fit into this? To me, it's a little bit surprising because like at least, so I would expect we still don't see declines in FHFA Q3. That's what I would expect, because it would be strange if we do, because we haven't even seen the percent overvaluation to decline. And that one had like the 3 quarters leading kind of ahead of the price decline that we've seen before. So it's a little bit surprising. So how does it fit? It's a little surprising. Another thing that's a little surprising is price declines in San Francisco, for example. But that's like, because San Francisco is actually undervalued. Okay, but that can have an explanation. So first, it can be something very short term again like this. So it's not going to show up in the data afterwards, when you get it quarterly at the home metro area, et cetera, et cetera. The second is, well, it's not a valuation kind of decline. It's a decline of the fundamentals themselves. And so because San Francisco is experiencing extreme massive population outflow, so okay, so that's what the issue is there. And since you're getting over economic weakness of maybe potential incomes could later decline and so forth in the future, not yet. And so are we in a recession? Like the first question, I go by, like in these studies, I go by like if like the NBR said it's a recession, because I don't know what's the impact of that, right? So if they didn't say it's a recession, but you're saying it really is it different in terms of what results in the economy if it was actually declared? Maybe no, because they declared it after the fact. So maybe there is no actual impact in real life, right? So to say. But again, I kind of, for this study to be valid, I kind of based it when there was actually a declared recession. And so now there isn't yet. So I don't know. I mean, let's see, maybe we do have it. Maybe it's going to get declared a couple of quarters from now and so forth. And we're already maybe in it. That's what most people expect, I would think. But it's just because it's not declared yet. It kind of remains a little uncertain if we're going to see any of this just yet, because I don't know, because I haven't studied cases of non-declared recessions or something like this, and then see what happens to real estate prices afterwards. So I don't know. So it could matter, it could matter, like it could affect even like buyer. I mean, consumer confidence has been extremely low already, but that's been all inflation driven all the time. And like with the stock market, so on and so forth. And so, yeah, but I think like for me, like the thing to kind of focus on is not like it's not some kind of doomsday thing of, again, if something is overvalued, I want to address it in the positive direction, that if something is even 84% overvalued, in a mild recession will decline only 90%. We got if we now get the 1990 scenario, Boise declines only 19%. That's not terrible. That's the most overvalued city in the country. You know, it's not terrible. So that's the first thing. But the second thing I kind of want to direct is from a portfolio allocation perspective. If like I speak to like these different investors in like a few different investors, let's say somebody even in Idaho, I know. And so, okay. And so they think Idaho has those very strong fundamentals, which it does. And what they're missing is if a market has extremely strong fundamentals, but they're exceeded, you know, in whichever way, then that is an issue still the same way, just like here. And so because inherently by definition, something like these 50 to 60% buckets, by the way, they had very strong fundamentals at the time. That's why they got so overvalued. The correlation of performance and how overvalued they got was very high. And so Hawaii, again, the example then. Hawaii was the top performing state. So people who invested in Hawaii ahead of 1990, they would be thinking, oh, they would just jump on the train and invest in Hawaii, and they would be thinking that's going to be the best investment because it's booming as hell. It had appreciated over, I think it was 150%. I have to check it. That market cycle was a huge appreciation, or over 100 for sure, like triple digit. And so, and then they invested at that time. So how can you explain to someone in 1990 that afterwards, 8 years later, prices are going to be lower in Hawaii, the most booming state in the country in price appreciation terms? And so that is for me like the implications to somebody investing now in Idaho. And, you know, because investing in Idaho that's over 50% overvalued is something very similar if we get a mild recession to me, because you're overpaying. And yes, it does have by definition strong fundamentals. I get that. That's why it's the most booming in price performance terms. But also in this study, they exceeded those fundamentals by additional 50%. And so that's kind of the issue. And so here, like the go again, yeah, just on a positive note. So first thing is being percentages may sound kind of high, but it's not indeed necessarily global financial crisis by any terms. It appears overvaluation is strangely to me, and to my surprise, ended up approaching that, which is very strange, quarter after quarter. And now at Q2, suddenly it's close to that, which still wasn't close to that even at Q1 of this year. And so now it's suddenly close to the global financial crisis overvaluation. But again, it doesn't mean we're going to get any of the same declines, because we can have a very strong economy, for example. So we don't know about that part. And so decline's not necessarily big, but the perspective where you buy, like you buy, again, Tampa, let's say, and it's 40% or something, you buy Tampa, and the perspective where, oh, Tampa, we get a mild recession, oh, it drops 10%, but I'm going to be buying those booming markets because they drop, I want them to drop 10%, but then increase 40%. That's what most investors are thinking now. I'm not going to be investing in like freaking Northeast that is depressed. I'm going to invest where it's going to drop 10% in mild recession, and then it's going to increase 40%. That's what most investors that I've spoken to are thinking. And that's a very reasonable thing to think. But that's not what this is suggesting if they went to be overvalued to a given percentage of 20, 30, 40, and so forth, because it becomes that if we, I think the explanation for these relative performances intuitively is that, say we get a recession, those markets, they have higher economic, better economic fundamentals. Sorry, we're just running low all the time, over time. So they have stronger fundamentals compared to other ones. But those fundamentals kind of compress in a recession, because incomes, they slow down. They even often decline a little bit in a recession. And so those fundamentals, they compress. And now you have between the bucket of -10 and the bucket of +50, you have a 60% gap that needs to be overcome under those compressed fundamentals. And now what happens is that it's not like I'm advocating for Johnstown, Pennsylvania, but Johnstown, Pennsylvania in Q2 of this year appreciated over 10%, which was an extremely interesting thing, because it's one of the most undervalued ones here. So I wonder if it's then if there is also a rebalancing that sort of naturally happens in the market of, or some buyers starting to buy there, sort of like the way markets work. I don't think too much. So
in all the scenarios here, though, like of the mild recession, you're
yeah.
saying a couple of years until there's recovery from a recession.
For the mild ones.
Is that true?
For the severe scenario, that it's 2 years or 3 years, you mean? That there is decline, not the recovery from the recession, just the decline only is 2-3 years. And then
So
the recovery to actually break even is I mean, for them it's almost too much, almost the same because they have very small declines, but a little longer generally, yeah.
So in the event that we're in a recession, you don't see us coming out of it for another at least 6 years to 8 years.
Yeah, the overvalued ones, yes. If there's even a mild recession declared, I don't see it come. That's what the history suggests. Now it's gonna be 4 to 6 years. That's what for those two. Now we could have now a different recession. I don't know. This is just scenarios. I don't know. It's hard to say like how it plays out, because to how it plays out, it's not forecasting what kind of crash we have that we get a bit crash. I think this is the wrong question. I think there is this misunderstanding that GFC is some kind of real estate crash. What is actually happening there is that this is this crazy weak recovery recession that by pure economic research center is, like I said, declared one of the worst recessions, over a couple of centuries. And so and because the recovery is so weak, and because those declines, they naturally take in real estate a very long time, over those 5 years, there's global financial crisis, no recovery. Okay, so you get hammered on prices because there's no recovery. So it all goes on the price side, essentially. And if you have a strong recovery, then it's okay, then you get pretty mild on the prices, and then the rest resolves, right? But we don't know what's going to happen in that way. But yes, that's the past. This is like 47 years, and like what kind of recessions we had in these 47 years. And these two are like kind of notable examples, let's say. Suggest 4 to 6 years durations, even in mild or severe, for anything that's over 20% overvalued, let's say.
And these are single family homes, or also you see
so this is predominantly, that's actually important to know again. This is not commercial multifamily, for example. This is like, FHFA price data, which is basically single family. Yeah, I would assume it's going to be not too different for like anything up to 4 units, but generally, yeah, it's like single family, just the housing market. That's all it is. It's not commercial. And commercial is actually interesting because then is it that I don't have a good study. I've been trying to do a study on like cap rates for that, but it's much harder and I don't have that good data. And for the housing market, it's very easy to do it because the data is available. And so, yeah, if in case you're a commercial investor, just know that, it's different. But it's also different, not in a fundamental sense. It's also different, again, in just your valuation method. That's what like commercial investors, they say, oh, after GFC, we got this very small decline because, it's like commercial real estate is valued differently. I don't think it works like that. I think, they did get a smaller decline then, but I don't know how one could measure that one overvalued or not, because I'm guessing it could have been less overvalued. And now if we take something like some of the markets that experienced very strong rent growth, and knowing what rent growth does to cap rates, for instance, right? Because rent growth is very fundamental to cap rates, even like theoretical cap rates. They're directly correlated to rent growth. And so considering that, what it has done to cap rates in those markets with the 20% rent growth, I don't know what overvaluation is in commercial. So I don't know, actually, I don't have information, but intuitively, I might think that in those markets could even end up this time to be worse in commercial than in residential. Because we haven't had like excessive lending or anything in residential. And now we have these numbers. We've seen on the syndication side and investment management side that huge boom in commercial and everybody making a fortune essentially over the past couple of years. And so intuitively, I would think maybe commercial is more overvalued. But I don't know. I just don't know. And so, but for the housing market, that's kind of how it looks. And yes, 4 to 6 years for anything that's overvalued, such as 20% and above. But if you have a mild recession on the plus side and you invest in the undervalued ones, it's very brief. You're just gonna not feel it. It's gonna be like a few months up to 1 year, and it kind of keeps increasing. And so, durations are brutal. I don't know. That's how long it takes. And the more, if the other thing is, if you're thinking, let's say that a mild decline is a good thing, I'm not sure. That's what I'm saying. I think the secondary question is how much prices actually decline. The important thing is what valuation you buy. If you buy a very high valuation, like 50 to 60, and you get a mild decline, what this means, most likely you're getting this mild decline over very long duration, like here. The highest duration we have here is the mild recession most overvalued bucket that is higher than even anything at global financial crisis. And that's because it's overvalued a lot, and because exactly the decline is very mild. And so that very mild decline, well, guess what? It's going to take a while for it to resolve with this very mild decline and strong economic recovery. It's going to take some time. And so that's how Hawaii was dragging for 8 years, and other markets on average 6.5 years. But yeah,
do you have any projections on like when it would bottom out? Do you have any projections on like when recessions usually bottom out? How long?
Well, that's what this is. So this is the bottom. This is peak to bottom decline. So this is, we get a peak, whatever. Let's say if we peaked now in Q3 or who knows when, and then it's, or in 2 years, I don't know when, and then 4 to 6 years later on it bottoms. There's never like a crash that is super instant. Like there can be to your property. Maybe your property now got hammered and somebody reports it, but that's not what is at the aggregate, you know, metro area or something like that. At the aggregate metro area, you get the first year after the peak, you get around a quarter of the decline in the first year. That's what I've seen, like around a quarter, let's say. And then it just keeps going down, but it's like trickling down, you know, it's not a, it's a slow, painful process. And many people, like people who are around, I spoke on this webinar to people who are around the global financial crisis. They do report this. They know that, you know, it took a long time to actually, like, prices were, this is just price history. So this is not my model. So these average decline durations, they are what FHFA price history suggests. So yeah, 4 to 6 years in overvalued ones in both a mild and severe recession, but in a mild recession in under to fairly valued ones, less than 1 year duration. So you get out of it pretty quickly. Now, the tricky part is, let's say you have a business and you need to like get investors. What are you going to do now? Like, what are you going to do? How are you going to get investors in, like, again, freaking Northeast or somebody? Nobody wants to invest there. They want to invest in the South. They have they're mentally set to this. And so it becomes harder. But because if you look at what I showed in the back studies, sorry, the metro area correlation was actually so high, 88 or like, I think 89, you know, I think percent, was so high. It actually, I found that if you bought undervalued metro areas in overvalued states, their metro area valuation still holds, and they don't get kind of hammered that they're in the wrong state. So for instance, like if you bought undervalued areas in Georgia or something, you could do maybe that and kind of have business in some of those areas in the South. So the South has undervalued metro areas right now. So the biggest count of undervalued metro areas is the Northeast. Number 2 is the South, even though the South is overvalued with Texas and Florida and Tennessee and some others, but it's got many states, and it's got like some states that are not overvalued, and it's got the second most undervalued count of MSAs, and then it's the Midwest. But yeah, but on a high level, if we took the high regions, it's the Midwest and the Northeast that are in the bottom buckets, and then the South and the Western. And the West has nothing has no metro areas that are undervalued, except California has some of them. And okay, there's one in New Mexico. Okay, but those are, I don't know, New Mexico does count Southwest or whatever it counts, I don't know. And so, right, so California basically has got the fairly or undervalued stuff, because California, like the narrative there that's been this market side, because California is expensive, we're going to get out of California, we're going to buy Nevada and Arizona and Utah. And so, and that's what drove Idaho overvalued, because Idaho, like, who would think Idaho is going to be the top price performer this cycle? Like, nobody. Like, why the hell would Idaho be the top price performer? But it's because it's just one of those Western states, and kind of like exodus from California and so forth. But because that has been the narrative, California is absolutely expensive, but it's relatively inexpensive. And so in this kind of thing, it's not overvalued at all. Well, it's actually gone a little bit overvalued now, because like overvaluation spread out a lot, and now it's been pretty much everywhere in most states. 39 states are already overvalued, and So even in Oklahoma, if you are, it's overvalued. And so that's kind of, so that's why even California is there, but it's like the least overvalued Western state and like very different than the other ones. And yeah, any other questions before we wrap up? Sorry, if I can go on this probably too much, but I think the implication is, to me, is again, it's not like something, it's just to understand the impact of that the impact is not just the impact in the mild scenario, I think is the real insight to me. Because in the mild scenario, the fact that it kind of drags for so long, they become so stagnant for those not very big declines after all, right? That's kind of a bit of an issue. And so that's like something to understand, that if you're getting a small decline, that small decline is coming at the price of time. And you're gonna get a longer time. Even if
Wait, where are you gonna post the YouTube video? The slides?
Video is gonna be here. 1 sec. Let me paste it again. You can subscribe to our channel. Yeah. So the data for this, once again, so the data, just FYI, we offer this as a service or whatever. So it's actually offered for like
Come in.
If I'm working.
Oh, I have no idea where parking is around here.
Sorry. So yeah, so this is gonna be a theoretic one. This is a theoretic1.com/analytics. So it's actually available for almost every county in the country. So if you wanna sign up for that, it's probably an easier way rather than, I don't know, or if you wanna reach out to me, I can explain. If you wanna do the similar study yourself, it's like pretty straightforward fundamental analysis. So it just, yeah. Okay, so that's all. Okay, thanks guys for joining. Have a good night.
Good night. Thanks so much.
Yeah, cool.
Thank you.